It's 5 o'clock in London. It's midday in New York, midnight in Hong Kong, 4 a.m. in Sydney, 9 a.m. in San Francisco, and 10:30 at night in Mumbai. Greetings, good morning, good afternoon, and good evening, depending on where you are in the world today. My name is Patrick L. Young. The IPO-VID live stream, Series 27, Episode 3, which in totality makes for our second of the beautiful Alfetta series. Episode 159 starts here. And welcome, all the best, to Pravina Rai. She's the new CEO of MCX India, the leading commodity exchange of that huge nation. And indeed, I do believe she's the first woman to lead an Indian commodity exchange. Meanwhile, the parish of exchanges are showing great results overall, particularly in the USA, while DB1 has been leading in Europe. As always, Intercontinental Exchange last week led a masterclass into all manner of market facets. Of course, one of the areas which was discussed last week in the investor call was the ongoing repercussions about the NYSE ARCA proposal to extend stock trading to 22 hours a day. As that continues to reverberate, the interesting news is that we're hearing about more people going 24/5, none other than Charles Schwab, the latest to join that group, although Fidelity, it seems they're going to stick to essentially US daylight hours. Also reverberating a lot of annoyance at the FINRA issuance of a license for a futures commission merchant to the CME Group and their brokerage arm. Total annoyance all round there, but it's not quite a whole brave new world as MIAX bought their FCM last year, but the worries of conflicts of interests remain considerable in the exchanges world. And of course, in case you haven't heard it, ladies and gentlemen, there is an election on today in the United States of America, and it's a very, very big day. Kalshi were only licensed in the past fortnight. They had to go to court in order to manage to make sure they were, and they've already matched over $200 million on the head-to-head of that bloke versus the other woman, whoever it is that happens to be campaigning to be the president of the United States of America, and may the best person win, however they identify. So let's see what's happening in that election result. We hopefully might know by next week's show. In the meantime, we've got a fantastic show for you this evening for episode 159. Our guest is Cody Azmoun. We're going to be talking about US retail equity trading in focus. Cody Azmoun is CEO and co-founder of Blocks Markets. They're building a retail-focused trading venue, bridging the gap between retail and institutional investors in US equities. Based in New York, Cody has over 15 years of experience in sell-side electronic trading. Cody, welcome to the show. I suspect I might know the answer thanks to masculine intuition, but where in the world are you today?
First, thank you for having me. And I am currently in New York City, Midtown.
Midtown, how fantastic altogether. Nestling in between all those places that used to be hotels and have now been turned into condos. That seems to be the fate of Midtown Manhattan these days.
Unfortunately.
So tell me, Cody, how did you manage to get into US markets in the first place?
I had a small stint at Morgan Stanley, an internship cold calling for wealth management. I realized that wasn't my calling, and I had an opportunity to join a electronic trading firm out in California. And fortunate enough, they offered me an opportunity. Started in operations, engineering, client-facing, and eventually I was invited to join their technology executive committee. And it was a great experience. And then I fell in love with electronic trading since then.
Fantastic. So that's really, really interesting. And where did you actually start? I mean, where were you born? Sorry, were you born on the West Coast or born on the East Coast? What?
No, I was born in the Middle East, but we migrated to California early on, and so I've been raised in north of Los Angeles. Small town called Sherman Oaks.
I beg your pardon?
A small town called Sherman Oaks.
Sherman Oaks. How interesting altogether. Wow. So quite a story, a classic American story of arriving in the nation and then going on to prosper. So tell me, I mean, what got you to the point where you thought that, well, there are already 50 American trading platforms, exchanges, and whatever for American equity. So what we really need is another one. How did that come about?
It's funny you say that because I'm always on the other side of that trade where I always question a new venue coming on board also. So to be fair, I think the U.S. electronic markets are very entrepreneurial, and there's a fair barrier of entry where, new incumbents come in, and the market will decide if the product is innovative enough. So I think from that perspective, it's great. It allows the market to become more efficient and creative, and the market participants will decide on the usefulness of this. And so those venues will either succeed and grow or wither and die. And so I get your question on why another venue on top of the existing 50 plus venues. So when we looked at the market, ultimately, we noticed a inefficiency around marketable retail flow, specifically payment for order flow. And we realized the SEC was creating an opportunity similar to that of Reg NMS was first introduced back in 2005. And so in that opportunity, we determined that, with the upcoming retail rules that the SEC was looking to pass, and this was initially introduced again in December of 2022, the new rules were going to disrupt kind of the existing binary relationship the retail brokers have with the market makers. And in doing so, it would create an opportunity for additional flow to sort of come off exchange to on exchange. And by on exchange, I mean more exchanges or ATSs would see some of that retail flow. And so we thought early on, there is an opportunity, but either we go after it now or someone else will. And so we planted our flag really early, and we started focusing on it.
Fascinating. So just break that latter part down for us, and we'll get to the macro of the US equity market in a moment. But is what you're saying that effectively you're looking at some form of new system that improves the relationship rather than going directly to a broker-dealer for payment for order flow? Or how are you trying to find your particular niche?
Right. So the way we kind of describe our venue is we're bridging the gap between institutional investors and retail investors. So we're going to offer an opportunity for you to directly access retail flow rather than having to go through other intermediaries. And we'll do it in an open and fair manner on an ATS. From the perspective of the market participants that can access the retail flow. So the other market participants, we classify them as the buy side, sell side, other market makers potentially. This gives them opportunity to now compete, a fair chance to compete for that retail flow in a manner which they may not have access today. And it also reduces potentially information leakage and ultimately market impact, and then which leads to better execution quality down the road. And so that's part of it. The other part we looked at is retail brokers essentially are going to get affected. The ones that take payment for order flow today, are going to get affected by some of these new market structure rules that are being implemented, and they're going to be adversely affected by them potentially. So we wanted to create a venue that essentially can help bridge the gap between institutional and retail investors, and in doing so, deliver a better execution quality experience for both parties.
Very interesting. Okay, so I can see pretty rapidly, and of course I'm sitting today in Poland, so therefore we're outside of the zone of where payment for order flow is permitted, but I can see rapidly how retail can potentially improve their offering. Explain to me how this is going to work for institutions insofar as, do institutions really want to be dealing with tiny, tiny amounts of stock? I mean, aren't they more keen on dealing with, say, blocks in order to manage to transact?
So when you think of institutions, I guess you're referring to maybe the buy side firms and some of the sell side firms out there.
Yes.
So the short answer is the feedback we got from the buy side was when we surveyed them, the majority of them expressed interest in interacting with retail flow because today they have to access it through other intermediaries, and they're concerned around information leakage and how that would impact their slippage. So in short, the solution is we would offer them a direct way to access retail flow, but support their existing workflows, you're saying, and they would be comfortable getting smaller lot size fills throughout the day. And so we've developed a solution where, from the buy side's perspective, whether buy side comes directly to us or coming through us through the sell side, we will support both workflows. And in order to access retail flow, they would accept smaller lot sizes. And the answer from the majority of them was yes. The rest of them kind of said, we're busy, come back when you're ready.
Okay, that's a very interesting response. So explain to me, why can the buy side not do that already with other market platforms?
So when you say other market platforms, you're referring to exchanges and potentially
exchanges and ATSs.
The other ATSs.
Anybody, yeah. Mm-hmm.
Correct. So theoretically, they could do it today. The problem is the retail flow currently goes through other intermediaries, and so there's a lack of liquidity for them to access, and that certain type of retail flow we're going after. And so there's essentially is limited access to it, right? The retail flow we're going today is essentially off exchange retail flow, and it's a large segment. And so they have limited access to that. And so in order to access it today, they have to go through an intermediary who has access to the off exchange. Okay. And so that's the reason why they don't access today through the ATS or other exchanges. And what they do access is a limited amount of it, essentially.
Okay, that's very interesting and much clearer. Now, can you give us an indication? I mean, how much business overall is being done through these sorts of channels off exchange at the moment, in a proportion or number of shares, any sort of metric?
Sure. So we looked at it from the perspective of the 606 reports. So 606 reports that we're able to measure. And, I guess we should be fair and say we're looking at it from a 606 report, but we're also looking at it from a single counted view perspective. The last time we looked at the actual percentage of payment for order flow, retail flow was roughly around, I want to say 23%, give or take. And the marketable percentage of that was roughly around 17% and this is in the perspective of the total composite volume. So total composite volume on a daily basis is, let's just say, roughly 22 billion shares a day on average. It could be more or less, but 17% of that is a significant amount. So that gives you a perspective of the retail marketable payment for order flow that we're focusing on initially.
And that's quite an incredible number, actually, isn't it? Because one of the things that a lot of people, I think, don't follow is, as far as I can see, I mean, where once upon a time retail was almost everything a century ago, and then was almost nothing a generation ago, the world of electronic markets, retail really is quite a player again. I mean, it's been growing quite significantly over the course of the last decade or so, if my memory serves me right.
That's correct. If you look at retail flow from, let's just say 2010 till now, it's more than doubled at least in the US markets, it's more than doubled in volume. And you see that growth continuing. It was really COVID, which triggered a bump in that. But post-COVID, we saw that bump continue to grow. So it wasn't just, it was good to see that growth continue to happen. But to be fair, it was gradually growing over a longer period of time.
Very, very interesting. And therefore, so explain to me, I mean, at the moment, a lot of this flow goes off exchange and it does the payment for order flow rumba. On your platform, is it still possible to have payment for order flow, or is there some other advantage that's going to drive that business onto your platform?
So we don't offer payment for order flow, but we do offer an order book that provides rebates similar to other trading venues like exchanges out there, and potentially other ATSs that provide rebates too. So it's in the perspective of payment for order flow, no. Right? In the payment for order flow, it's a single intermediary providing payment for order flow to be routed to them only. In our case, it's our venue's open to both retail brokers. It's open to everyone, right? We don't in any way discriminate against anyone. It's fair access. From perspective, by that I mean we allow everyone to access it. Anyone can take liquidity, and if we can post liquidity, but we do have more than one order book. And in one of the order books, they do provide a rebate. In the other order book, it does not provide a rebate. But both order books are retail focused in a nutshell.
Fabulous. Really, really interesting altogether. So, I mean, tell us a little bit about this. You told about the genesis, and I have to say I was being slightly disingenuous when I asked you that question, Cody, because actually I think one of the great things about the US market is there are 50 odd platforms and they're all still finding intriguing market niches, to wit, Blue Ocean, that nobody thought was going to find a market niche in Asian whatever, and suddenly all of the rage is trying to trade all day and all night. What do you think is the sweet spot for your business, and what are your sort of targets or aims that you're going to try and deliver?
I think when we spoke to retail brokers, and take a step back, I think my team and I, when we were like, do we go back, do we continue what we're doing and take a 9-to-5 job, or do we try to do something better and in our approach? And I know this might sound cliche a little bit, but we actually thought, let's build a venue where we can provide better execution quality experience back to not just retail brokers, but other market participants ultimately, while still trying to, make a living at the same time. And so, the team and I were really focused on trying to improve execution quality ultimately down the road. And so that's part of it. The second part I'm adding to this question is, the second part I would like to add is that we believe that we can add a better retail experience by providing better, whether it's execution quality, and still providing the same rebate experience they receive today with some of the other trading venues. But ideally, our focus is to try to provide a better execution experience for all market participants.
We can add a better market experience for all participants. How fascinating. If you're enjoying this, ladies and gentlemen, please give us a little bit of love. It helps all those algorithms that are out there in the AI world, whether you're watching us tonight on Facebook, LinkedIn, or YouTube Live. It gives us an opportunity to get further up the rankings, and as a result of getting further up the rankings, we don't get any payment for order flow, but at least we do have the opportunity that more people will see the wisdom of Cody Esmond and other visitors and guests to this show. And as we talk about US retail equities trading in Europe, tell us, therefore, Cody, I mean, at the moment, what's the status with blocks markets right now?
That's a great question. So, to be fair, and we kind of put this for transparency purposes to everyone out there who we speak to, is, our trading venue is not yet operational. We're awaiting regulatory filing, and it is subject to regulatory approvals. But from our perspective, we hope to have, we've been focused, the team and I, which is approximately 5 people now, but we do have a 6th person who's consulting with us. But the team will expand beyond that, and we hope to have our, as we're focusing on the technology stack right now, we hope to have that resolved by mid next year. And we hope to have all our regulatory licenses in place towards the second half of next year. And we hope to be ready to operate by November 1st, which is the first leg of one of the new rules that will be taking effect.
So that's an interesting point. I mean, first of all, that gives you, therefore, 360 days, so a perfect bond year, as it were, in order to manage to get there from when we're recording this today on November the 5th. And I wish you all the very, very best with that. It seems plausible, by the way. I'm not trying, when I say I wish you all the very best, that some people might think I was being sarcastic, but I don't. No, I mean, that's quite a plausible, sensible, mature rollout time. That's very understandable. Can you give us a little hint? I mean, technology, is it a buy? Is it a build?
So that's a great question, actually. So when we first started this, we looked at models, how other ATSs outsourced it, the pros and cons around that. We looked at other ATSs building it, the pros and cons around that. And then we said, okay, if you build it from the ground up, if you want to build it fast, you have to hire a lot of people. If you're going to build it slow, but if you want to build it from the ground up, you have to hire a lot of people to build it fast. Otherwise, it's going to take a long time, as we've seen from other ATSs. If you outsource it to a vendor, you really have to have great contracts in place, because we've seen examples with vendors. You have a huge technology bill annually, and potentially your client IP is now being sold to other competing venues. And so that's a concern for us also. So we essentially adopted a hybrid approach where we're utilizing an open source stack, and then we're working with a vendor to help us build out kind of the foundational stack on top of that. So think of maybe the foundational stack as a generic ATS today. On top of that layer, we have our open source stack, which is kind of our client IP that's not shared with our vendor. And then that essentially creates kind of a hybrid solution. It's more cost effective. So it gives the best of both worlds, right? From an outsourced standpoint, you get to the market faster, right? But from the kind of building from the ground up standpoint, we have part of it as our own client IP that we don't share with the vendor. And so we get the best of both worlds in there. So it's more cost effective, optimally getting to the market while protecting our client IP at the same time. That's kind of the first part we look at it. The second part is I think we looked at a dozen plus vendors initially, various vendors where you can, and open source platforms incorporating that too. And we narrowed it down to a couple vendors, but we really came down to kind of picking out a technology stack. And it's kind of our mission at Blocks Markets. Like we say, while we're in the process of developing a new retail-focused U.S. equities trading venue, we are utilizing emerging technologies to kind of broaden access and enhance market efficiency. So we looked at a tech stack that was forward-thinking, that's using newer protocols or newer concepts, more robust, and still maintaining a low latency and high performance. And we tested a number of different solutions, and we're partnering up with an existing provider. And we have seen great success with it, that it's going to put us on par with some of the other fastest venues out there, as well as some of the other venues with high performance.
So that's a very interesting question, because, I mean, do you think that, you say high performance, maybe you can give us a little bit of granularity to there. Do you really believe that you need to be very much in the HFT ultra low latency space in order to get a lot of this flow working? Or simply you mean that you can have high performance by scale?
Both, actually. So from a low latency perspective of HFT, there is quite a lot of demand from the institutional, when I say institutional, I'm referring to the sell side, market makers, as well as the buy side. But there essentially, speed is a criteria when it's ranked for best execution, believe it or not. And then there is the amount of messages you can manage. You can manage on your trading venue, right? So this is considered like referring to as an order capacity issue, right? So as you grow, right, you need to make sure your environment can support the stress that's going to be put on it as more messages come in, more orders are executed, and so on. And a lot of the ATS as a startup originally are planning for a smaller environment. And as they grow, they're going through what's called capacity upgrades, essentially, or infrastructure upgrades. So we wanted to have that kind of set up day one, early on, or a trading venue that can support that day one and scale very easily without any risk to the environment, right? So we focused on two things, or let me rephrase that, three things: low latency, scaling, and robustness. Because when you do upgrades, it's also important. Are you replacing everything on the underlying infrastructure? Or are you just adding another server? And are you diversifying your risk? Are you putting everything on one server? Or you're able to diversify your risk and put it on multiple servers while still maintaining low latency and high performance? And so those are the things that we looked at, right? So low latency, high performance, and robustness.
Very, very interesting altogether. And of course, we have seen various different approaches to that, as you mentioned. I mean, for example, we had Blue Ocean, who were on the show a few months ago, and they started with all of their own code. And then eventually, when they started to scale up and get really hefty volume, suddenly they jumped and they actually just brought in Memex across the board to provide a lot of their matching engine and related technology. So that was the way that they dealt with it. So there's different ways and means by which people are trying to square that circle.
I would argue that Blue Ocean ATS, aka Boats, it was my understanding they also used a vendor as part of that process, and they built out the other part. So you can say maybe they used a hybrid solution.
Right. No, that's fair. I think that's a fair comment altogether. Now, that, of course, brings us then elegantly mentioning the wonderful folks at Blue Ocean Technologies and so on. What is your Thank you very much, by the way, to Bata Young for that wonderful comment. Love another pogo dance by Pogo Trick or Patrick. Thank you very much for that. Get some comment. Do please ask a question if you'd like to of Cody, if you've got anything you'd
Don't
like
ask
to say.
any hard questions, please.
No, not about pogo tricks or pogo dances, certainly either. So, I mean, Cody, when we're looking at this whole mix in terms of what you're seeing, Blue Ocean have obviously come out. They're running late at night. We've seen the announcements. I mean, the world is moving in terms of the trading hours that are open. What's your sort of take on what you expect Block's market to be offering in terms of market hours when you first launch?
So to answer your question, I have two parts to that, but to answer your question, we are going to be just regular market hours, 9:30 to 4 p.m. That's our focus. As an ATS, you can build many functionality into it over time, but early on, you really just want to focus on one segment and build that out. And I think for us, it's just 9:30 to 4 p.m. We have no appetite to get into overnight trading. And the reason being is right now there is already a number of market participants in there. And I want to say kudos to Boats because I remember the original CEO, I believe his name is Gregory Shinnick. Apologies if I got that incorrectly. He gave a speech, or he was on a panel in a CFA event I attended a while back. And it was I think it was 2017 or 18. And he was initially pitching the concept of Blue Ocean. And I thought, wow, this is great. This is forward thinking. No one's doing this. And so they were going to, kind of lead that charge. Fast forward to 2024, they've done that successfully. And, now under Brian Hinneman's leadership. But with that being said, it's a very crowded space. And so we want to focus on 9:30 to 4 p.m. regular market trading hours. We don't want to enter the overnight trading space. And we're already seeing, I think between, Blue Ocean, Interactive Brokers, Turquoise, NYSE, OTC Markets, potentially two or three more participants getting into it. It's going to be a very crowded space, and not everyone is right now focused on U.S. equities. We're seeing some of it is Reg NMS equities, OTC markets, potentially getting into options. So it's going to be an interesting landscape to be interacting with down the road.
Fascinating altogether, Cody. We're just about halfway through the show, ladies and gentlemen. I'm with Cody Asmoon. We're talking about US retail equities trading in focus. He's the co-founder and CEO of Blocks Markets. Let's go, ladies and gentlemen, give Cody a break for a moment. I think he deserves to have some water and a refreshment at this juncture. And look at, well, first of all, let's have a little short video. Back over in the UK, growth remains remarkably strong, but politics is telling us a different story. Barely 110 days in, 120 days in now, and after a fairly disastrous tax-raising budget, which has rather backfired, the UK Labour's government is, well, not having a pleasant honeymoon of it all. Meanwhile, in Big World.
So last week we were looking at the perils of the European Union and their huge growth problems and other issues. Let's cross the channel for a moment. Is it nirvana in the United Kingdom? On the top line, it certainly looks fantastic. GDP growth is appreciably higher in the UK than it is in any of the other G7 advanced European Union economies. Growth looks to be good, but underpinning this, there is a problem. That problem is all driven by politics, and it's the Labour government. Elected only 110 days ago, they're already in deep trouble. Accusations of corruption, cluelessness about what they're actually trying to do, general political foibles, and indeed a huge issue in terms of what they're going to do in order to fill a black hole, partly of their own making, in the UK government's finances.
For more in Big World, like or follow. Well, there's a cheery message for you, ladies and gentlemen. And of course, this is in the United Kingdom. November the 5th signifies Guy Fawkes Night, when they burn effigies of a man who tried to blow up Parliament. So absolutely no relationship there to the US election taking place today. Whereas, of course, the UK, they tastefully had their election on July the 4th, which was American Independence Day. How circular these things are. Anyway, speaking about the circular economy, and also the opportunity for retail in markets, where better to go than crowdfunding? And our book of the week this week is Crowdfunding, How to Raise Money and Make Money in the Crowd by Modwina Rees-Mogg. Modwina, you may remember, was a fantastic guest. She was very early in this series. Good grief, IPO-VID 17, back when we were still gripped by COVID and all of its related, particularities. that was Startup Pluralism with Mudwinner Rees-Mogg. It's a great show altogether. Her book, Crowdfunding, How to Raise Money and Make Money in the Crowd, is the first book. It was the first book published in the UK to get to the heart of the exciting and fast-moving business phenomenon of crowdfunding. For our next book of the week, you can catch that on our weekend edition. Our weekend edition of EI is absolutely free. You can sign up for that at exchangeinvest.com. But at the same time, if you want to support us, ladies and gentlemen, as we're coming to you absolutely free on the interweb, giving you this live stream, don't forget, it's only $499 per annum to subscribe to Exchange Invest at exchangeinvest.com, and you will be an exclusive member of the Exchange of Information. Back to Cody. Gosh, you're also automatically already on screen. Lovely to see you again, Cody. So we're here talking about US retail equities trading in focus. If you've got any comments or questions, do please drop them by, ladies and gentlemen. Drop us a little bit of love as well. It's always much appreciated. Sorry, my heart making's not really with me today. Tell me, Cody, you've mentioned this a couple of times. I mean, you talked originally about obviously the Reg NMS framework way back 2005, whenever that was. But in recent times, there have been quite a large number of US regulatory changes, and they're due to come in fact, as you mentioned, or start coming in November the 1st next year when you hope to launch. Are those proposed changes actually favorable to your business model?
Yes, and I just realized you told me this is going to be more than an hour long, or an hour long. I thought this was going to be short, 30 minutes. I was like, oh, great. No, I'm kidding. I'm excited for the hour. So the changes are beneficial to us. When we first looked at this post when we looked at this in 2023, we said essentially we're seeing similar changes being resurrected back in 2025, or a similar moment where early participants who, kind of planted their flag back then have grown to be behemoths of companies. And we wanted to be in a similar opportunity where we said, okay, we're going to plant our flag now. We're going to start working on this. And, first, let's just start getting feedback from clients. And the feedback was positive, overwhelmingly, at least from the retail brokers, the buy side, and the sell side, and other market makers outside of the top spots. And if we could create a retail ATS, and if these rules were to fruition, it would be a great momentum for us, or at least give us a wave of boost to move forward. So yes, they were a bit helpful.
Cool. So what are the particular elements that you think are most helpful and are going to be most beneficial for retail traders?
So when we if you look at it from like a top level, right, there's going to be tighter spreads ultimately. There's going to be a lower access fee cap. There's going to be more transparency around your execution fees. And so those ultimately will lead to a better execution quality experience for the retail broker. I'm happy to dive deeper if you like.
Very interested. Actually, do have a quick dive, because what we're going towards full decimalization in this round, yeah.
Well, when you say full decimalization, can you be more specific?
Well, I mean, we're going to decimalization even fractions of a penny, if I remember correctly, in the largest stocks, right?
Right. So there will be in come November 1st, right? There will be you're right. There will be a new tick size, and it'll be half a penny. So there will be X amount of stocks that will be part of that new tick size, based on the time weighted average quote spread formula. And there will be all lots will now be part of the MBBO. How that is going to be implemented, there's still some nuances on the separate all lot order book quote. So we'll see how that gets implemented from a BestX or OPR perspective. And of course, access fee caps. So exchanges today, if you're trading if the stock price is $1 above, the max an exchange can charge you today is 30 mils, right? So that's 0.3 of a penny. That is going to get reduced to approximately 10 mils, or 1/10 of a penny. And you're going to see rebates from exchanges also get reduced, probably because the rebates are essentially a function of what they can charge the other side of the trade. And we'll see the reduction in rebates probably from 0.3 of a penny to somewhere a little bit above 1/10 of a penny. And so,
Okay.
go ahead.
Interesting. But now, how does this work? I mean, with rebates and the actual payment for order flow is not going to be affected in the new rules?
Well, the underlying, the market makers essentially make money off the spread, right? The wider the spread, the more profitable the trade for them ultimately. So I think the aggregate rules itself is going to make the market makers less profitable as far as tightening the spread through tick size, through inclusion of odd lots in the MBBO, include access fee caps going down, right? All those things will have a factor that will adversely affect them, as well as adversely affect retail brokers, because some retail brokers will also route to exchanges directly themselves, not necessarily relying on another party to route on their behalf. So it will definitely disrupt the process, and it will have to, we'll see what happens down the road. But ideally, we believe it will have an adverse effect on the binary relationship today that exists between market makers and retail brokers.
Interesting. So therefore, that should also hopefully be good for you. But do you think that amongst these rules, that therefore it's going to be good for retail and it's likely to further increase the participation of retail investors in the market overall?
I think it will be a net benefit for retail investors, because ultimately it'll increase the execution quality experience for them, and so they should hopefully get better prices.
Okay, that's very, very interesting. And I mean, with the election coming along, do you think that there's going to be any particular difference to how this might be approached if we see a change of SEC leadership between this year and next year, as is actually probably quite plausible come what may in the electoral cycle?
Anything's possible. I think the feedback we've received was that since this, the first two, so there was a number of retail market structure rules proposed on the equity side, and two of them, the first two, 605 and tick size and access fee, were had a 5-0 vote on when they were initially proposed by the SEC commissioners, and when they were voted on, or the rule was finalized, they also had a 5-0 vote. So I think that highlights good bipartisan support there on both those rules, and so we don't anticipate those rules potentially being challenged, given the fact that they have a 5-0 vote. But anything's possible. So I think if the Republicans win and sweep the election, where they win both control of the legislative and executive branches, then theoretically, they could potentially claw back any rule within a certain time range. But the probability of that happening, I think, when we speak to political analysts from banks, is like right now, given the recent poll results over the weekend, is no more than 30%, and I think it's like even like 20% for a Democratic sweep. So I think those first two rules, 605 and tick size and access fee, for the most part, stay as it is, regardless of whether it's a Republican or Democratic president.
And actually, you make a great point there, because those votes of 5-0 certainly were very different to the votes that we saw with, for example, Reg NMS itself, which had a very, very politically disrupted. I mean, it was essentially the Democrats on one side and a lot of Republican angst on the other side over those when they were first coming in. So I think that's fair to say, quite a lot of difference to the way that is going in the overall market space. So when you're looking at these, and obviously these rules have been essentially finalized, and hopefully they're going to come in by next November, but we shall have to see. That's all in the hands of the gods. What do you think is the most interesting element to how the US stock market has been developing for retail in recent years?
Well, in recent years, I would argue overnight trading is probably, taken before overnight trading is, I think Robinhood was, and concept of payment for order flow had always existed previously to Robinhood, but Robinhood was innovative in providing a very user-friendly experience and platform to younger retail investors and providing commission-free trading and leveraging payment for order flow to achieve that. So kudos to Robinhood, and they've done a great job of growing their business model and expanding it over time. So you saw a wave of commission-free trading kind of take place over time and expand it to every retail platform in a nutshell. Outside of that, if you see, I think overnight trading has also taken effect. So not just retail investors domestically, but globally want to participate in the U.S. equity markets. And if you think about it, the U.S. equity markets are the behemoth of all equity markets out there. They are, important when it comes to our economy, creating jobs, growing businesses. And so from our perspective, I think it's great to offer the transparency and the robustness and allowing any retail investor globally to partake in it. So focusing on commission-free trading and overnight trading are the kind of the two key themes we've seen over time. But I think with the new SEC rules that have been finalized will also allow a better execution quality experience or fair share for retail investors. Also, on top of that, moving forward.
In fact, that's perfectly timed because our commodity doyen, Anne Berg, has asked a question. Hello, Anne. Good evening. Hope the weather is good in Chicago today. What, in your opinion, have been the most important factors in US equity growth and capitalization versus other regions post 2007-2008 financial crisis?
Post 2007, 2008 financial crisis. Wow. You're getting me here a little bit. I would not. I can't argue for 2007, 2008. My answer is I don't know for sure, but I do know. I want to argue that one of the things we had was decimalization, Reg NMS prior to 2007, 2008 being implemented, but post, I would argue, going back to kind of things we highlighted already, is in general the U.S. markets are fairly transparent. I think that's very important when it comes down to it. Two, I think commission-free trading definitely fueled some of that. So I know that's maybe, forwarding a little bit for years before 2007, 2008. So let's just say 2015-ish. And now you have kind of a wave of overnight trading, giving access to the retail markets. So I think for international investors or investors for other regions to see similar growth, I think you have to have provide them access to other regions. And so those are kind of the things I would say, Reg NMS, decimalization, commission-free trading, overnight trading, and now you have these new SEC rules that are coming in place. So there's a number of factors, but ultimately, transparency in your markets, transparency in your government, these are things that help for it.
Very interesting. Thank you very much for your question, Anne. Much appreciated. Great to see you this evening. So when you're looking across that whole realm, how do you describe very, very quickly how you see your opportunity playing out? Is it an opportunity for you to be permanently retail focused, or do you see yourselves becoming more of a player with other niches?
So our focus is going to be retail focused to start. I think there's already a number of institutional players there. I think the value we can add there is limited already. So we want to cater to retail investors. And I think early on, when my team and I sat down, we wanted to make a difference, believe it or not. And so when we evaluated the opportunity out there, we saw, okay, this is a great way for us to create a venue to not just bring liquidity to the institutional investors, but bridging that gap between retail and institutional investors, but opportunity for us also to increase the execution quality experience to all participants. And so we are retail focused, but again, early on I said our venue is open to all participants. So we don't discriminate against whether it's retail or institutional. Anyone can access our venue. But again, we are retail focused, and we plan to be retail focused for the foreseeable future.
Okay. And in terms of that, retail focus, what's the best way for your go-to-market strategy without asking for your secret sauce? But presumably you've got to work to make sure that you're very high on the speed dial, as it were, of the major retail brokers like the Charles Schwabs and the Robin Hoods of this world.
Well, we've definitely talked to many retail brokers, and over time, they have become better partners for us, and in that they've been supportive of our venue and providing us the necessary feedback for us to move forward. So we do have a good amount of retail brokers, buy-side participants, market makers, and sell-side participants who express interest in our venue and verbal commitments for the most part. And so we're happy with that process. More importantly, from a go-to-market strategy, I think in the interim, the team is right now kind of focused on three things. Our tech stack, preparing to file our regulatory filings, and closing our next round of funding. So those are the three things we're focused on immediately as part of our go-to-market strategy. But as far as clients goes, I think we have a good amount. I think we would say we've spoken to well over 70 market participants, and there's more that have reached out to us to speak out to them, and we do apologize to everyone for not getting back to them in a timely manner. That's for sure. Something that we should probably do better. But 50 plus have definitely at least expressed interest in our venue.
It's very interesting. And I mean, obviously, it's quite a strain on a team of only 5 people, as you are at the moment, to manage to talk to all of those venues while trying to put together your tech stack and organize the rest of your plan and write your documentation for the SEC and the good folks at the regulatory bureaus. One thing that interests me, I mean, as you're setting up, is actually the access to funding. How have you found that so far? I mean, pardon my ignorance, have you been self-funded so far, or did you already have an investment round?
So, well, this is an interesting question to ask. So we had an opportunity to receive funding early on, and we kind of decided to self-fund it primarily because we didn't want to hurt our valuation. So the team and I made a conscious decision to allocate our own capital to this early on. And we did it, one, for not to hurt our valuation, but two, we had the capital, and we thought based on the feedback received, based on the opportunity, it was a good risk to reward ratio opportunity for us. And so we made that investment. Over time, we've raised some more capital from other investors, and we're just doing another round as we speak. And if all goes well, hopefully we'll have that closed soon, and then on to the next.
Excellent. And if you don't mind me asking, I'm not looking for names, but what's the kind of tenor of your investors? Have they been traditional kind of VCs? Have they been high net worth? Have they been actually other capital market participants?
Our investors and potential investors range from ourselves, family and friends, angel investors, corporate investors, and traditional VCs.
Very interesting altogether. That's thoroughly exciting, and I wish you all the best in tying up your next round as fast as possible, and therefore being able to fund yourselves to market. So when you look at this whole US equity market at the moment, I'm just curious, you've got a particular niche. Other people have got very specific particular niches. I'm thinking of IEX. We had Ronan Ryan on the show, gosh, all the way back when COVID was a thing as well. How many other platforms do you potentially think the US equity market could support as it goes along?
It's as long as there's market inefficiencies, there can be additional platforms. I do think you make a valid point. At some point, you do hit a saturation point on venues, but I think the market will decide if a new incumbents to the market the market will determine if it's well worth it or not, if there's true innovation there or not, and the venue will either succeed or perish.
Very interesting. So therefore, I mean, as we're approaching the end of the show, I mean, you talk about the opportunity for different platforms to survive, to perish. However, I suppose, Cody, what I'd like to ask you is the question we ask every guest at this point in time. This has been a great discussion about US retail equities trading in focus. And Cody, I mean, tell us, where do you think the capital market revolution will go next?
That's a great question. We're going to see more growth in overnight trading. We're going to see more growth in retail opportunities. Hopefully, we'll participate in that. But more importantly, I think we're going to see the U.S. markets continue to grow and lead the way.
short and sweet with continued US primacy. So therefore, that's a great optimistic note to have on this historic election day. And all I can say in addition to the historic election day is do what the good folks of NICE and ICE were encouraging you to do, which is please, if you have the privilege of a vote today, go out and use it. Exercise your mandate if you'd be so kind, but don't necessarily do it in the fashion of that classic Irish politician who suggested that you should vote early and often. Use it once, use it judiciously, and have a great day at the polls. Cody Asmoon, I want to say thank you very, very much. This has been a fascinating discussion all about blocks, markets, your opportunity, the overall structure of the US retail equity market, the overall structure of the US equity markets with 50 plus MTFs exchanges et al., which is a quite fascinating state of play. And it's just intriguing to see what happens. And I really hope we'll get a chance to talk to you, maybe not on the 1st of November next year, perhaps not even the 5th of November next year. But why don't we make a date that we'll try and check in with you, if not at the very tail end of 2025, sometime early in 2026, and find out how it's going in terms of your application of what is a very, very interesting methodology against the SEC changes to their marketplace. So thank you very, very much, Cody, for joining us. My name is Patrick L. Young. Thank you also to all those who commented today. Woman on it, Tabata Young, Anne Berg. Next week, we got a fascinating show. We're going to be doing IPO-VID 160. It'll be called Mellow Your Money. And we're going to have as our guest a fascinating fund manager, Mick Heyman. So that'll be fun to talk to somebody from the buy side for a change. It's been a few weeks since we had somebody from that fraternity joining the show. Let me just add, of course, you can catch up with all of the news and information about the world of exchanges, the business of bourses, the exchange of information itself, exchangeinvest.com. Do please join us there. Sign up for a subscription. Help support these live streams as well. My name is Patrick L. Young. Thank you very, very much to our fantastic production team today. Thank you to Herminia, Janella, Jamil, and also indeed in the background, Beata and AJ. And my name is Patrick L. Young, saying thank you once again to our guest, Cody Asmoon, and wishing you all a great week in life and markets.